on those reports and plenty more besides. Adam Dawes is joining us from Shaw & Partners. Dawsy, good Friday morning to you. We're all a little bit worse for wear, I think,
yes,
at the end of this week. Wesfarmers share price down by close to 2%. I was wondering if the market would be focusing on what has happened or potentially what is to come. Where's your focus?
Yeah, it looks like the what is to come is going to be the flavour of the day for Wesfarmers. They did guide to slower or a declining in sales for 2022, and they said that the first half earnings in their retail business would be below the prior period. So, look, I think they're warning shareholders that it's not going to be as good as it was last year compared to this year, because it was a stellar result from Wesfarmers going forward. Strong performance in all of their businesses. Certainly Kmart and Target, they're turning that around, and obviously Bunnings is massive. And I think also people, potentially here in New South Wales are looking at now Bunnings has been closed down. I mean, that's just taking the right of every man to disappear for half an hour to go to Bunnings just to, buy a screwdriver. But look, that's certainly something that I think that we need to keep an eye on, because of some of those stores will probably drag on revenue a little bit. But what I was very pleased to see was that dividend, 90 cents per share, bringing the full year dividend to $1.78. That's about 17% higher from where it was last year. Plus also then giving a $2 share capital return to shareholders. Obviously that has to be approved via the AGM, but I suspect they'll approve that fairly quickly. So yeah, a bit of a mixed bag for Wesfarmers today.
I will say that there are women out there who take a half hour to go to Bunnings and buy whatever as well, myself included. Sometimes I come home with firewood. Sometimes it's something more interesting than that. Anyhow, Adam, the point with Wesfarmers that we need to flesh out a little bit more is, if you're a holder of Wesfarmers, is there any reason to get out today necessarily based on the result? I mean, because you can look at other parts of the Wesfarmers business. They're making some inroads into other areas. It is still a conglomerate. It's not all about Bunnings and Kmart.
Correct. 60% of its revenue does come from Bunnings, but you're absolutely right. There is more to come from this one. I think they still have a takeover bid for API, Australian Pharmaceuticals Industries. So that that's all the Priceline chemists and things like that. So I think they'll do quite well with that. They're also looking at battery technology. They've got some some lithium plays as well. So yeah, it is a conglomerate. Their war chest is very, very big. I wouldn't be selling Bunnings here. I think this is a great opportunity, especially after the capital return, to pick up some more Wesfarmers shares. These guys know exactly what they're doing. They've got long-term views on the world, and I'd be really comfortable to pick up Wesfarmers on any kind of weakness. The stock has done very, very well over the last 3 months, 6 months, and even longer. So it's a behemoth, but I think any kind of weakness is a good opportunity.
Does that hold true for NextDC? I note that the share price is down by about 2% in the wake of its result.
Yeah, big capex number there. You were telling me $500 million. It's quite interesting, because obviously NextDC is data centers. And to get those data centres in the areas that you want, let's say Sydney, Melbourne, even Brisbane now, it is quite expensive to get that retail land to put your big warehouse in there to store your racks. So I think that's probably what the market's focusing on, is a very large capex number. You're right, it did come in at sort of that below end of that guidance range. And they declared no dividend as well. So I think they're keeping the coffers full for that capex number, which is a bit of a surprise. Look, again, NextDC's done very, very well over the last 3 to 6 months also. Probably a little bit of profit taking coming in there. I'm always a little bit cautious when you've got a big, large capex number like that. So I've been on record, I prefer GDC, which is a smaller play. But look, NextDC is the best in the business for Australia. So it's an interesting one. I'd keep an eye on it. I think you might see some more weakness on that one in the next coming couple of days on that capex number just alone.
All right. Well, they are expecting services revenue to come in between 285, 295 million, which would be an improvement on last year. But yeah, big capex spending there. Okay, so that's NextDC.
Yeah. Yeah.
Biga cheese. I got to say,
Yeah.
Adam, I'm not afraid of saying that Biga is my preferred brand in terms of just plain old tasty cheese. It's doing quite well with the range that it's got right now.
Yeah, it has, and it really, that Lion Drinks or that Lion Dairy acquisition really now starting to come through in the numbers. But this is only about 6 months worth of that Lion Dairy acquisition coming through in the numbers, and obviously they were able to lift profit by threefold, which is absolutely fantastic. Look, this one should continue to do well. One, on that acquisition, I think it was a very, very good acquisition. These guys are obviously making peanut butter, Vegemite, cheese, Yoplait, those kinds of things. I think this really sits well. We've also had some really good rains, which is going to help the milk production, which is going to help with cheese, those kinds of things as well. It was a big concern a couple of years ago about the drought, how that would affect them. I think those concerns have obviously disappeared, and the business is running at a very, very good profitability level. So yeah, it is a good preferred brand. I know that some of the other cheese brands are changing brands and doing some other stuff as well. But I think Bega is one of those staples in when we always talk about bread, milk and cheese. I think Bega is one of those names that you should definitely gravitate to.
And peanut butter. Are you a smooth or a crunchy man, Adam?
And peanut butter. Crunchy.
What?
Come on. Crunchy.
No.
There's no other way.
I'm smooth. All right. I will quickly check in on Biga's share price, and it's doing really well, up by 3.5% right now. So we find ourselves at the end of the real thick of reporting season. Adam, did you call it right?
Yes. Did I? Look, I think overall, market was looking for outlook statements and some real expectations on what these companies were going to do. And I think more than half of them did actually give some outlook, but it's overall, most companies haven't been able to give that outlook. And that maybe concerns me a little bit, that we need to be careful about the next year and how businesses are going to run. First, with this second lockdown or third lockdown, whatever you want to call it, we're always thinking, okay, well, it's only the small businesses, the cafes, the hairdressers, they're the ones, but the big businesses are still doing well. I think now through this reporting season, we've actually seen, yes, they've done well, but there is going to be a little bit more pain to come next year for some of these businesses, the likes of Wesfarmers and Bunnings and things like that, Woolworths supply chain issues, those kinds of things. So, yes, I was very pleased with it. I still want to, probably next week we'll get a wrap-up of who, the good, the bad and the ugly, and maybe I can come back on the show and give you a bit of a more of a reporting season wrap-up.
We'll be calling you for that, Adam. Let's not pretend, all right? So we'll pick it up then. Thank you so much for joining us today. Adam Dawes there.